We're officially into 2023, and I have yet another housing market prediction from the experts. This week, I'm going to talk to you about Redfin's predictions for the housing market for this coming year in 2023. They had a much longer list than Zillow's. I'm going to cover pretty much the most important ones that I found on their list and share that with you. And I'm also going to give you my opinion because, that's what I do. I can't keep my mouth shut. As a realtor, I got to throw my 2 cents in.
That's it. Go.
And is it collapsing, or are we going to come out of this okay? Well, they're a little bit doom and gloom, but in the end, we may turn out okay. So let's take a look at this right now. Redfin's first prediction: home sales will fall to their lowest level since 2011 with a slow recovery in the second half of the year. I'm not upset about that. I do hope the prices come back down, and I kind of like this prediction. But let's read in detail what they're saying here. Redfin expects about 16% fewer existing home sales in 2023 than 2022, landing at 4.3 million, with would-be buyers pressing pause due mostly to affordability challenges, including high mortgage rates, still high home prices, persistent inflation, and a potential recession. People will only move if they need to. Yeah, I can kind of see that, especially with the people who still have the lower interest rates. They're still apprehensive to make a move. I don't agree with that. No one's going to move. I mean, yeah, people move if they need to because life happens. Okay. People start having babies. They need a job transfer. Whatever, unfortunately somebody passes away, that home needs to get sold. So things will sell, but will the inventory increase to where we need it to be? And I've been saying this for a long time. It's not going to get back to pre-pandemic levels, nor will the prices get back to pre-pandemic levels. I don't think we'll see that for a very long time. So let's continue on with what Redfin says. Existing home sales will likely fall 31% year over year in the first quarter, followed by smaller annual declines in the second and third quarters. By the fourth quarter, existing home sales will be flat from the year before. Sales will slowly start recovering as rates fall from their peak, but they'll still post year-over-year declines most of the year. We expect about 20% fewer sales of newly built homes, landing at about 500,000 nationwide. When buyers don't want to buy, sellers don't want to sell. Low demand plus the lock-in effect of homeowners with ultra-low mortgage rates staying put means new listings will continue to decline year over year during the first half of 2023. They go on to say here, another possible existing sales scenario is that they'll decline by only 12% in 2023 from 2022, landing at just 4.5 million. That could happen if inflation consistently slows faster than expected, allowing the Fed to slow its pace of rate hikes and leading to quick mortgage rate drops. But if inflation persists, sales could drop by up to 27% year over year. I could get behind that. I mean, look, we already saw that the end of 22. In October, we saw the mortgage rates hit 7%. And then come mid to end November around Thanksgiving, they fell back down again because inflation started to come back down. So as long as that trend continues, which I'm hearing from a lot of other people other than the Redfins and the Zillows of the world, people in the mortgage industry that are saying they think this trend's going to continue. We're going to get below 6% in 2023, probably in the mid 5s. But let's continue on and see what else Redfin has to say. Mortgage rates will decline, ending the year below 6%. So they are saying they're going to come below 6%. We expect a 30-year fixed mortgage rates to gradually decline to around 5.8% by the end of the year, with the average 2023 home buyers rate sitting at about 6.1%. If inflation cools faster than expected and the job market moderates, rates may decline sooner and or more, dropping to 6% at the beginning of the year, then settling around 5.8% for the rest of the year. But if inflation proves to be stubborn, rates are more likely to stay elevated for several months and decline slowly before ending the year just below 6%. House hunters may need a higher credit score or low debt-to-income ratio to qualify for a mortgage as lenders tighten credit standards due to rising unemployment. That said, those who do qualify may pay less in closing costs as lenders offer fewer products, which allows them to lower fees to attract customers during the slowdown. So keep that in mind. If you're going to be going for a mortgage, make sure that your credit is good. You have a low debt to income ratio. I can totally get behind this. The banks, the lenders are getting a lot stricter with qualifying people for loans right now. Ever since what happened in 2008, I mean, the rules were tightened since then, but even more so now because of the possibility of somebody losing their job. Now, going on to the third prediction, home prices will post their first year-over-year decline in a decade, but the U.S. will avoid a wave of foreclosures. Hallelujah, I can get behind this. We're seeing prices come down for the first time. And I know those of you who are sitting in your homes, you're looking at me like, what's wrong with you? Our values are going down. No, they're not. Hold up. Let's continue reading this. I'm excited for our new buyers out there who are being killed by these super high prices. Redfin goes on to say that they expect the median U.S. home sale price to drop by roughly 4%, the first annual drop since 2012 to $368,000 in 2023. That's due to elevated rates and final sale prices starting to reflect homes that went under contract in late 22. Prices would fall more if not for a lack of homes for sale. We expect new listings to continue declining through most of the year, keeping total inventory near historic lows and preventing prices from plummeting. Prices will start their decline in the first quarter, falling by roughly 2% from a year earlier, marking the first year-over-year price drop since the beginning of 2012. Home sale prices will likely fall by about 5% year over year in the second and third quarters, then ease to about 3% drop by the end of the year as lower rates bring buyers back into the market. Where have we heard that before? So once the rates do come back down, people are going to enter back into the market. And then I don't want to say those two words. I'm not going to say it. Bidding wars. I said it.
Oh dear, outside, never mind.
Another possible, albeit less likely scenario is that prices will stay mostly flat on a year-over-year basis in 23. That could occur if mortgage rates and or new listings fall faster than expected, which would prop prices up. But if inflation remains stubborn, rates stay higher than expected, and or supply increases more than expected, prices could fall by double digits. They're covering all their ends here. So they're giving every possible scenarios. We can predict all day, every day, twice on Sunday, and throw our predictions, our opinions out there. But at the end of the day, nobody knows. Nobody knows. But nobody knows. I really still enjoy reading this stuff because I like to see what other experts are saying about this. And of course, I love to share that with you guys. Prediction number 4. Now, this is similar to the one Zillow had on, if you go back to that video, Zillow said the same thing. The Midwest Northeast will hold up best as overall market cools. Housing markets in relatively affordable Midwest and East Coast metros, especially in the Chicago area and parts of Connecticut and upstate New York, will hold up relatively well even as the U.S. market cools. Those areas tend to be more stable than expensive coastal areas, and they didn't heat up as much during the pandemic home buying frenzy. On the other end of the spectrum, we expect prices to fall most in pandemic migration hotspots like Austin, Boise, and Phoenix, largely because the huge increases over the last 2 years leave a lot of room for prices to decline. Expensive West Coast cities are likely to see outsized price declines because of stumbling tech stocks and the shift to remote work pushing so many people out of those markets. Totally agree with that. And like I said, Zillow had said that too. And I think this is going to be the market to watch. And I said that before. We're going to look at the Midwest and parts of the Northeast. Going to be pretty interesting. Their fifth prediction, rents will fall and many Gen Zers and young millennials will continue renting indefinitely. I don't like this one. I don't like this at all. So Redfin says here that they expect U.S. asking rents to post small year-over-year decline by mid-23, with drops coming much sooner in some metros. Some large landlords are likely to offer concessions such as a free month's rent or free parking before dropping asking rents. The rental price declines will be partly due to increasing supply, which has already led to an uptick in vacant units in apartment buildings. Multi-family construction is at a 50-year high, which means hundreds of thousands of new rental units will be available next year. Another factor is reluctance to sell. Many homeowners will rent out their homes rather than sell because they don't want to lose a low rate. There will be an influx of single-family homes for rent. Zillow talked about that as well. So they're kind of in line here where they're saying a lot of people who bought second homes. You may recall I talked about this. Zillow was talking about all the people that bought second homes during the pandemic. They're now going to turn around and rent those out. So Redfin's saying the same thing. So they go on to say here that some Gen Zers and young millennials who have saved up some money to buy a home but are able to wait until prices and or rates come down will focus on financial pursuits other than home ownership next year, like investing in stocks, while they continue renting indefinitely. Now, let's go on to prediction number 6 because this ties into this whole thing about the renting. It says here, builders will focus on multifamily rentals. Builders will continue to pull back on constructing new homes next year with the year-over-year declines of roughly 25% in building permits and housing starts continuing into 2023. Builders will back off most from building new single-family homes. Construction of single-family homes surged during the pandemic, which means builders need to offload those homes that they have on hand without adding more supply to limit their financial losses, which I totally understand that. I get it. You know, they were trying to meet up with the demand and then things kind of went awry and now they're stuck with all these homes. I get it. They're in business and, you know, somebody had commented this to me a while ago, like, you got to give these builders a break because they're in a business to make money. Totally get it. Not bashing that. But Redfin goes on to say this: constructing rental units, including apartment buildings and multifamily houses, will make more financial sense for builders next year as rental demand won't fall off as much. Rental building activity is likely to fall slightly in 2023, but not as much as construction of single family homes. Some construction spending will shift to remodels, as many Americans who are hoping to move will instead opt to renovate in the face of high mortgage rates. So this, and then prediction number 5 about how Gen Zers and millennials are going to be renting indefinitely. I'm sorry, the builders are feeding that. They're the ones that are going to be making that possible. And I get it. They're in the business to make money. I totally understand that. But we're really hurting our millennials and Gen Zers right now. I get it. The homes are really expensive. Affordability is an issue. But like, you're putting out these rentals to say, here you go. You guys are just going to want to rent. We'll make it more enticing for you. It'll be cheaper than owning a home. I get that, but you're not owning a home. You're paying off that corporation's mortgage or that landlord's mortgage. That worries me a little bit.
Me too.
I think I'll talk about that at a future date, about Gen Zers and millennials and what's going to be happening with them, because this really bothers me. Prediction number 7, investor activity will bottom out in the spring, then rebound. I'm really curious about this one. Real estate investors will purchase about 25% fewer homes than a year earlier, with purchases likely to bottom out in the spring. Investors' business model is to buy low and sell high or rent high, and the cash they borrow to buy homes outright is no longer cheap. Fewer iBuyers in the market. Redfin recently announced plans to shutter their iBuying business, is also a factor in slowing activity. Some investors, especially newer and smaller ones, will bow out of the housing market entirely, and others will slow their activity. But if inflation slows and the Fed eases up on rate hikes as expected, investors will likely start buying more homes in the second half of the year, taking advantage of slightly lower home prices. So let's keep an eye out for those investors, because they're the ones who are going to be driving those prices back up again. Dear God. Prediction number 8 from Redfin: Gen Zers will seek jobs and apartments in relatively affordable mid-tier cities. Here we go with the renting again. Gen Zers are entering into a workforce with more remote work opportunities than ever before, which means they'll have more flexibility in where they'll choose to start their careers than older generations. They can prioritize things like affordability, lifestyle, weather, and proximity to family. Nearly 1/3 of adult Gen Zers live with relatives, partly because inflation and high housing costs make it hard to afford living alone. That will allow some Gen Zers to save money in the long run and eventually use it to move where they want to. They can choose low cost of living places, or even places that have paid remote workers to move in, like Tucson or Savannah. Mid-sized, moderately priced places like that will be popular when more Gen Zers age into home ownership. Though it will remain difficult for first young timers to buy homes because prices and rates make it more expensive than it used to be. Some Gen Zers will still prioritize job hubs like New York and Boston because their employers can call them to the office, or because they prefer working alongside experienced colleagues or prefer big city amenities. That could help hold up rental prices in those parts of the country. As a matter of fact, Zillow's talked about like families buying properties together, buying homes together because they can't afford it. So I find this interesting about Gen Zers, although I get it. I understand that. that it's going to be better for them to rent for the time being until they can save up enough money to finally buy something. But I get the feeling sometimes that these people think, like these corporations and builders who are building these multi-rental units, these multi-family homes, saying that they're going to rent to these people. They're putting it out there that like this generation doesn't want to own, they want to rent. It's not true. It's not true. I've worked with a lot of millennials, actually a couple Gen Zers here and there. They bought homes. They bought homes. Why? Because they want to own a home. I'm just getting nervous here that they're putting this out there that, you know what, you can't afford it. You're going to have to rent. I don't know. I don't like that. It's bothering me. I'm not going to lie. It really is bothering me. But I get it. They need to save money. And if they could live somewhere where it's more affordable for the time being, that does make sense. But don't make it a permanent thing. That's all I'm saying. Just you deserve to own your own home. Moving on to prediction number 9. Migration from one part of the country to another will ease from the pandemic boom. Yeah, I'm not surprised at this one. We expect the share of Americans relocating from one metro to another will slow to about 20% in 2023, down from 24% this year. However, that's still above pre-pandemic levels of around 18%. But some people will relocate next year, including retirees and remote workers who are still seeking out more affordable areas. For the Americans moving for affordability, places with no state income taxes like Florida, Texas, and Tennessee will be attractive. Number 10, rising disaster insurance costs will make extremely climate risky homes even more expensive. This is interesting too. Some Americans will be priced out of climate risky areas like beachfront Florida and the hills of California because of ballooning insurance costs. We expect disaster insurance rates to continue rising next year and beyond, rendering housing in some areas more expensive. Absolutely. I can totally see that. The increasing frequency and intensity of natural disasters has prompted some insurers to stop providing coverage in risky areas altogether. Others are raising rates for flood and fire insurance. Florida property insurance premiums increased 33% year over year in 2022, and they're expected to rise more after Hurricane Ian wreaked havoc on parts of coastal Florida in September. Americans with FEMA flood insurance, especially those in Florida, Mississippi, and Texas, are also starting to see their flood insurance premiums increase after the government agency overhauled its pricing. California, many private insurers have stopped covering high fire risk homes, which means many homeowners and buyers must use a last resort plan and spend 2 to 3 times more on premiums. Oh, yes. And speaking from being here in New Jersey, too, we do have a lot of flood areas and we've had our share of natural disasters. So especially those who choose to live on the Jersey Shore. Oh, my God, the flood insurance, it's through the roof. And when some people are looking to buy a house and they see, oh, houses in a flood zone, what's the big deal? What's the big deal? Your flood insurance is going to be almost like another mortgage payment per month on top of what your mortgage and taxes are. So this is going to be a big issue. I don't know. It's going to be a big problem. Prediction number 11, more cities will follow Minneapolis's YIMBY example to curb housing expenses. So YIMBY means yes, in my backyard. If you remember NIMBY, not in my backyard, now we have YIMBY. More U.S. cities will look to Minneapolis, which in 2019 became the first major city to eliminate single-family only zoning for inspiration in keeping rental and home prices under control. Earlier this year, Minneapolis became the first metro area to see rents decline. Some places have already followed Minneapolis's example. Portland, Oregon, and California are altering rules to allow for denser housing. Other places, including Alexandria, Cambridge, Mass, and Gainesville, Florida, are also changing policies to allow more affordable housing. Those places are showing that the YIMBY movement is working. Next year, we expect more local and state governments will eliminate single-family only zoning, allowing more multifamily buildings, townhouses, and ADUs. That helps ease expenses because denser housing is typically less expensive. I totally see that. I can totally get that. I mean, this is how they're coming up with creative ways to have cheaper housing costs for people, more affordable prices for people. But again, we're going back to the whole rental thing. And I just think this is just dissuading people from buying a house. We need affordable housing, affordable single family homes. And I get it. It's expensive. The materials have gone through the roof. It costs a lot more now to build a home. With the rising costs in lumber, the supply chain issues, look, it's just made it really damn expensive to get a house. I appreciate what these local governments are trying to do, but I think more needs to be done to be able to allow the average person be able to buy a home. Look, I know I'm a real estate agent. Of course, I'm going to talk to you about you need to buy a home. But even me, me as just a regular person, like I want to own my home. I want to have equity in my home. I want to be a home owner.
Yeah. That's right.
And that's where a lot of people are at nowadays. Okay, great. You're providing all this affordable rentals, but we need people to be able to buy their homes. What do you guys think about that? What do you think about all of these predictions that Redfin is saying? I'm really curious to hear your opinion on it, because I'm sure you're sick of hearing my opinion. But
Yeah.
tell me, what are your opinions on it? Do you agree with any of these predictions? Let me know. All right, so that's what I have for you this week. That's Redfin's prediction. And I mean, does it look like it's collapsing? It kind of sounds like it, maybe in the beginning. But again, it all comes down to the inflation, and it comes to the unemployment rate too. As long as unemployment stays low and the job market is good and inflation does continue to trend downwards, we could be into a more positive situation on the housing market. But as we know, it could always swing the other way. So we just need to keep watching that. So if you want to learn more about what's going on, navigating the housing market and all that fun stuff, you can check out this playlist over here. I think you'll really like it. Thanks for joining me today and getting your dose of real estate reality. My name is Jackie Baker, and I will see you next time.